I want to fund a policy with as much money as possible, and I want to fund that policy for as long as I possibly can. Have you ever heard this statement? Have you ever made this statement when you've been interested in a high cash value life insurance policy? When you look at whole life insurance policies that are specifically designed for high cash value, what are the worst years about a policy? When you're laser focused on the cash value, it's the first year. Usually the first and second year where I have less money than what I paid into the policy available in cash value. What are the best years of a life insurance policy? Every year after the first 2 years, I get more and more of my money back. It begins compounding and gets better and better. The cash value begins compounding. So this is a question we hear from time to time. How long can I pay into a policy? We typically hear it in relation to a 1090 split as well. A 1090 split, what this is a specific way to design whole life insurance policies where of our total payment, we can squeeze the minimum premium down to 10% with some of the top companies, your 4 major mutual companies like a Mass Mutual, Guardian, New York Life, and Northwestern Mutual. And some allow you to go a little bit lower. Some smaller companies allow you to go well below a 10% minimum premium. But my point here is when we look at some of the top companies, a 1090 split is a beautiful way to minimize the premium, which minimizes the expenses, gives me more cash value upfront, gives me more cash value long-term, especially when I look at the guarantees and actual performance, not just projections, but it is a great way to maximize the overall cash value. A follow-up question, however, is how long can I fund a policy specifically with a 1090 split? Can I fund it, for example, for 50 years? Say I'm 30 years old and I want to pay into it for up until the age of 80 or until the day I die, so I can just continue to grow this policy, have access to the cash value, and then also leave a large death benefit to the next generation as well. That will happen if you continue to feed a policy. So can you fund a policy with a 1090 split, which will maximize your upfront cash value? Can you pay into it for a long time to reap the long-term benefits as well? And the answer is yes, but there's some additional information to be aware of, or we want to provide awareness here. It does depend. Some factors that it depends on are the insurance company, the product that we're using, the specific design. For example, if you said, I want to be able to fund a policy with a 1090 split to maximize my upfront cash value, and I want to continue to feed the beast and pay money into it for a long period of time, so I want both. I want strong upfront cash value and long-term cash value and the ability to feed it for a long period of time. You can do that with some insurance companies. As a quick example, if we look again at our major mutual companies, Mass, Guardian, New York Life, and Northwestern Mutual. Guardian is a company where if you really want to maximize the sweet spot, optimizing cash value and such, and I want a 1090 split, a 10% minimum premium, I can fund a policy with a 1090 design for 10, 15 years with their L121 product. Sometimes I can go for 20 years. But aside from that, if I want to be able to take out a Guardian policy and max fund it, call it for 50 years, I'm paying for a long period of time, often I'll have to have a 25-75 split, just with respect to how their PUA limitations work, their contract language, and just when you look at their PUA guidelines, having a 1090 for a long period of time with Guardian is difficult. So if someone likes the idea of a Guardian policy where I can fund it for 10 years or less, let's say 10 years, I'm going to max fund it with a 1090 split, and then I stop. Or maybe I just pay a certain dollar amount, a reduced amount from that point forward. Maybe it's just the minimum premium. You can do a lot of good with Guardian. So that's one option where, can I go for 50 years with Guardian? No. Guardian's great because of their flexibility. Now to pivot to a different company, Mass Mutual, behemoth of a life insurance company. You can easily attain a 1090 split and fund it for 50 years. And if life happens and you have to stop after 2 years, you can stop, no problem. And you do not need to decide up front. You can design that policy to be very flexible with respect to the time period that you want to pay into the policy. Now, when you look at differences between Mass and Guardian, these are just 2 quick examples. Guardian is a company that will allow me to commit to the minimum premium, and I can just add additional funds into PUAs anytime I want. Whereas Mass Mutual works beautifully if I am making a one-time per year payment on my anniversary date, which is when my premium's billed. So there's differences there. Company awareness, industry awareness is important here. And we can go through all the different limitations with different companies where their whole life products can be designed for maximum cash value. So my point is that was a lot of information. When I say it depends on the insurance company and the product and the design. There's a lot of material really that the agent needs to be aware of. If I'm working with you, for example, and you're stating, here's how much I want to pay into the policy, right? 30 grand per year, and I want to be able to pay into it for a long period of time, maybe 30 years or longer. I don't know right now. That's the position you're in right now. I would ask, or I would let you know, okay, well, here's the differences with the different insurance carriers we're looking at. When it comes to flexibility, if you want to be able to pay in $30,000 per year, if that's your dollar amount, is that something that you're comfortable funding one time per year, writing a $30,000 check for, or sending it through your online portal? Or do you like the idea of having flexibility, where you can commit just to a minimum premium, say $3,000 per year, and then at your discretion, you can add more funds over the course of the year up to a maximum of $30,000. Depending on your answer, we're going to look at different companies and products. I'll probably show you both and then hit on the different key points as well. So it's kind of like Amazon. You can see everything up front and then select the option that you'd like. But with those two examples, if I'm asking you that question, if you said, hey, I'm comfortable with the one time per year payment, the money's already there, it's not going to be an issue, Mass Mutual will work beautifully. If you said, I really like that PUA flexibility, then we can look at Guardian, commit to a minimal amount, add more funds at discretion, but we will limit ourselves as far as how long we can 10x that base premium without any underwriting, medical underwriting again in the future. So from an awareness standpoint, we want to be aware of the PUA limitations that the actual company has. So what are their guidelines when you read their PUA memos? What do they allow as far as your base premium to PUA ratios? The contract language is extremely important to look at, and always aim for the full truth, not half truths. Sometimes we hear from people we're working with that they're told you cannot fund a policy at 10x the base premium because a certain provision in their contract states that they cannot. And that is true. Why I refer to it as a half-truth is when you flip through the contract, another 40 pages later, you'll see here's an additional provision with the specific way your policy is designed where you can pay 10x the base premium into PUAs per year. So it's really just taking the time to understand the contract language. And if you have a policy and you like reading that stuff, if you're a consumer, you can absolutely do that. You might look at it and say, there's no way I'm reading that 100-page document that's so confusing. It puts me to sleep after page one. As the agent or agency, we should really be doing that and just equipping you with the knowledge so you can really get in the driver's seat and go full speed. So that's more so for agents. But it's important to really understand the contract language inside out, the PUA limitations that exist with each insurance company. It takes time just to understand that. So what we're going to look at in this video is as follows: an age 30 male. Regular preferred health rating, so second best class when we look at his actual health. And he's going to fund the policy at $30,000 per year. The number of years is unknown. What that means is we're going to look at as follows. He might want to pay into it for 2 years and stop, 5 years and stop, all the way up to 50 years and stop. But we want the policy designed in a manner where he does not need to commit to a certain funding plan up front. He can adjust the dollar amount and also the time period. He's 30 now, income's good, healthy assets. He might say, hey, at $30K per year, funding it for 50 years, that's up until the age of 80, I can do that. I'm fairly confident in my ability right now that I can do that. Perhaps by the time he's 60 though, 30 years is a long time, right? He's 60, he's halfway to 60 right now. By the time he's 60, another 30 years, he says, you know what? I don't want to do this anymore. I'll keep the policy, but I don't want to dedicate funds toward it anymore. I've got other things going on. I'm very happy with the policy, allowing it to continue to appreciate. Or maybe I want to begin to draw income against the cash value from this point forward. Or maybe he says, you know, after 5 years, I don't want to pay into it anymore. Let's pivot into a different strategy. Do I have to continue to pay into it? The answer is no, not at all. So we're going to look at one policy in this example that's designed in an identical manner, one policy, but with these different funding scenarios. This is meant to demonstrate the different methods that you can fund a policy and you can pivot as you go. We don't need to declare this up front, and the policy is not designed in a different way. I'll add this, is if someone comes to us and says, hey, 10 years, like this is exactly what I'm going to do, 10 years or less, I'm not going to want to pay money in beyond that, I'm just moving a lump sum of cash from one area to another, then I'll design the policy a bit different than what you'll see in this example, because we can minimize the term rider, insurance expenses, everything, to really juice the cash value. If we want the flexibility to go for a long period of time, there's a bit more MEC testing, technical details we do in the back end, just to make sure that the policyholder is set up properly so that it can really continue to feed the beast over time. So, design of the policy, 1090 split. So what this means here, of his $30,000 per year, we've got 10% directed toward the base premium. That inflicts the most financial pain, particularly in the first year when we look at our cash value. That's where it's the weakest. I was an art major in college, by the way. Definitely was not. But as the years pass, I do see premium dollars more and more come back to cash value, whereas PUA dollars, that's how I simply maximize the cash value. So we're going to look at a Mass Mutual example. A 1090 split is as low as they will even allow us to go. We can't set that base premium any lower than 10%. Otherwise, we get a big warning on the illustration software and the illustration that says this will not be approved for sale. So let's have some fun here. Let's validate the design first, shall we, before we jump to the Excel spreadsheet. So here's our policy, $30K per year. This is the example funding for 50 years. I'm going to scroll down in a minute. Annual net outlay. This is, if this is you, the 30-year-old individual, you're funding $30K per year in this example. If I'm you, and you're me, so if I'm you with the knowledge I have in the industry, just knowing how a policy should be designed, what to look for, here's the question I would ask. Where's my money going? Up here is your premium. That's your base premium. And then the rest is going into PUAs, just about. You know, I just want to be very clear in this point. LISR and LISR, that's their life insurance supplement rider. You'll see a death benefit or face amount here of just over $740,000. And then you'll see $2,000 here. That's a term insurance rider. The term cost is not $2,000. The initial term cost is a couple $100. We actually ran the term cost report. I'll scroll down there in this example as well. But the term cost is a couple $100 and everything else is going into PUAs. So this is a combination of money directed toward term insurance and also PUAs. Circle PUAs in blue. And then Ehlers, their pure PUA rider, which $25,000. So of the $30,000, we've got the minimum 10% base premium, a term insurance rider, which raises the death benefit. If you say, I don't care about the death benefit, what's the purpose of that? Well, if you haven't seen our policy design videos, the purpose of the death benefit is that it has a direct relationship to the upper right-hand corner of the screen. So here's your death benefit for a 30-year-old individual, almost $1.1 million. MEC limit. What are the core benefits to a cash value life insurance policy? Purely focusing on the cash value, that is. Safe, liquid, tax-free. Tax-free if we do not trigger a taxable event. It's not automatically tax-free no matter what. We can run into taxes. So one example is if a policy becomes classified as a modified endowment contract, what happens is that your cash value still grows tax-deferred. If you never touch it, you don't have to deal with taxation. But if you ever plan on accessing the cash value with respect to the gains, you've got to pay ordinary income tax on them, a 10% penalty tax. We don't want that. So how we prevent it is by not triggering a MEC, a modified endowment contract. And that MEC limit is steady for the first 7 years. After that, it resets every 7 years. It can often gradually decrease. So whenever we're looking at funding a policy for a long period of time, 50 years in this example, we overinflate it. That's why he's paying in $30,000, but our MEC limit was at $40K. And we would fine tune this a bit. We can improve the overall performance. But this was just a quicker example, not a quick example. It took some time, but there's a couple tweaks we can make. There's your funding. First year, $30K goes in. Total cash value, here's your money column, $27,500. So there's your pain point right off the bat. Second year, you're paying $30K again. You get just about all of it back, $29,000 to be precise. If you got $30K back, you would see it grow from $27,500 to $57,500. But then the next year, you get more than your $30K back. Each year it gets better and better. By year 5, how much have you paid total into the policy? $30,000 times 5 is $150,000. Okay? You've got 151 based on current dividend interest rates. So this is something we like to track each year with the actual performance. Now in this example, we are going to feed this puppy for a long period of time. 50 years to be precise. So annual outlay continues. Here you go. Going. There's year 50. Cash value almost, that's the paid up additions column, my bad. Almost $5 million. All right, so the cash value has continued to compound. There's your death benefit as well. Remember that it started out at just over $1 million. Your cash value has grown to almost $5 million. As your cash value grows, your death benefit grows with it. So the death benefit does account for the cash value growth over time as well. If I pull that cash value out, I'd see the death benefit go back down to the original $1 million figure. We're very close to it. But funded it for 50 years in this example. What I want to hit on quick before we look at the other examples, after 50 years, we stop the funding, no more out of pocket. Well, let's go down a little bit. One more page. Outlay report. And we can look at, and often do like to look at, the current costs, which is exactly what this is, and then also the guaranteed costs. So I can see what the worst case scenario expenses are with a whole life insurance policy. Because when we look to minimize expenses, here we go. Where's the money going? Total of $30K, annual net outlay. Here's my premium. Here's my LISR payment. Circle that again in gold. Because remember, a portion of that goes toward PUAs. How much is going toward PUAs and how much is going toward term insurance? There's the term insurance charge, first year, $235. Now we're keeping the term on for a long period of time. Term riders gradually decreasing over time, but still here we see it gradually increasing. If we ever decide to stop funding, guess what we would do? Chop the term rider off, no problem. Sometimes you have to wait a couple of years to prevent a MEC, but you see it gradually increase here. This is an easy report to generate. And if we keep on scrolling down, by the time he's 60, the annual term cost is about $1,900. And that can adjust over time. We can gradually remove some term. If the term costs go up or dividends come down a little bit, that would be a little bit higher. This is something we monitor as the years pass. Very easy to do, very easy to provide transparency on it. And there we go. By 80, it's about $8,000 based on the term cost left. You know, with term riders, when I see them increasing like this, as I see them higher, sometimes that can cause a little bit of concern for individuals, which I understand. What I always like to look at to kind of bring things back to reality or let them know, hey, this did go up, but the net impact to you was still more cash value. It'll always go back to the total cash value column or the net cash value column. The reason why is because that reflects your numbers net of all insurance expenses, everything. That'll always read total cash value or net cash value. So this is the 50-year example. Fun stuff, right? Here is, you know what, I'm gonna go back to the 50-year example, and here's what I wanna validate actually. So looking at this, if we look at your year 1 cash value, 27,569, year 5, 151. And if you wanna look at year 10, 341. Have that in mind? Okay. 30 years. Same policy, same breakdown up top. Only difference here is we're going to stop the payments altogether after 30 years. So 30K going in, cash value, 27,569. Year 5, 151. Year 10, 341. Only difference here, stop the funding altogether after 30 years. You'll also see the term cost stop altogether at this point in time as well. Got the option to chop the term rider off, which we did in this example. No more term cost. Then, same thing, we went for 20 years. We did a 10-year example. 5, and then even a 2-year example. We're going to lay all of this out on Excel side by side. You'll see in the 2-year example, cash value is identical the first year, not the 5th year because we stopped payments altogether after the 1st and 2nd year. So a lot of material here. Point of this demonstration is what? If you're interested in a policy, you don't know how long you want to pay into it. You want to make sure you have maximum cash value up front. You want a minimum premium in the event that life happens. It's very flexible because you've got $30K going in. Are you committed to that? Are you billed for that every year and forced to pay that? No. We can easily adjust it down to the minimum premium. Maybe I only want to pay $5,000, whatever it might be. A lot of flexibility to bounce up and down. People have appreciated that so much because life happens to everyone. And this is true of people who are putting in 6 or 7 figures per year versus those that put in anywhere between 1 and 10,000 or 3 and 30,000. Very similar from a design perspective. Exactly how corporations design them. Maximum cash value. So let's simplify this a little bit because this is a lot of material in the PDFs, and look at a side by side here. So what we'll look at here, these are the examples that we just saw in the illustrations, is first a 10-year scenario. If I'm you, I want to fund a policy for 10 years, but I might want to go longer, Steve. I'm not quite sure. Well, what would the numbers look like? From a design standpoint, we covered that. Everything's set up properly. Here we go. Policy design, or I should say funding. 30 in year 1, there's that cash value, 27,569. There's that death benefit. Between years 4 and 5, I'm breaking even. Test of policy design is it set up for maximum cash value. After 10 years, age 40, I stop. Don't pay another penny into it. We see the death benefit drop in year 11. That is optional, but we chopped the term rider off. We also exercised what is called the reduced paid up. That gets rid of the base premium. We don't always do that, depends if an individual wants to do it. But then let's compare this to the same policy, but I continue to pay into it. We're going to continue to pay into it for 20 years here. So before we just jump to year 11, what do you notice about year 10? The first 10 years in both examples. Is there any difference? No, they're identical. The only difference here is if this is you and you said, my plan was to fund for 10, but things are going quite well, better than expected. I want to keep funding the policy. You can. Maybe you planned for 20 and you said, things didn't go as well as possible or as well as I thought they would. Can I stop early? Yes, you can. So only difference here is that you continue to pay into it for 20 years, or 30 years in this example, and then stop. And then we'll look at one more. There we go, 50 years. So we've got 10, 30, and 50 years. I don't know why I said 20 earlier. Too many spreadsheets. So exact same thing. What do you notice through the year 10 mark? Values are identical across the board. If we continue to scroll down through the year 30 mark, not quite across the board, because the first example we stopped funding after 10 years. However here, 1.73, 1.73, same with the death benefit. See a difference there? Or the exact same figure there. And then the difference here is the example on the far right. We continue to pump money into it. Keep on feeding the beast, we can refer to it as. All the way up until age 80. This particular product, we can actually fund it up until age 85. That's how long premiums are due. If we wanted to go longer, we could consider a different product where premiums are payable for a long period of time. Point is, we can equip a policy to pay into it for a prolonged period of time and then stop earlier if we choose to do so. Here's things kind of in reverse. This is the 50-year example. There we go. 20 years. What do you notice here? Planned for 50, had to stop after 20. At the year 20 mark, there's no difference because it's the same policy. Difference is here, year 21 I stop. There's the death benefit reduction, chopped off the term rider, term costs stop altogether, and money keeps on growing over time. The death benefit will recover as well. And then same thing with 5 years. So if I really want to stop early, if I want to go even earlier after 2 years, can I do it? The answer is yes. So we covered in one of the prior videos, we want to stress test these examples, looking at the guarantees as well to make sure the values continue to appreciate and that we don't run into a MEC or anything like that. But when we start to look at short pay scenarios that weren't planned, if I'm deliberately planning for a 2-pay, it's almost, we can set it up very easily. But if I plan to pay for a long period of time, then I stop early. From a design perspective, I want to do a little bit of additional MEC testing there. And you can kind of see it here, give you a technical detail. If you're an agent, this will be valuable insight. And that death benefit begins to decrease here. Here you're fine, but in the guarantees, they'll decrease a little bit faster. And if it dips below, it'll be right around a $1 million death benefit, which would give you a 30K MEC limit. If it dips below, the death benefit needed to give you a $30,000 MEC limit. In the first 7 years, you can run into a MEC issue there. It's rare, so rare, but it is good to stress test policies just to make sure when we run into these situations. And it's easy to prevent if you ever see a case like, hey, this policy is going to MEC. How do I communicate this to the client? I'm freaking out, man. I don't know what to do. I mean, don't panic. There's always an option. A lot of times you have to dig a bit. We can always help you out if you subscribe to ILS or Training Business. We've run into those situations before. A lot of times insurance companies won't provide the solutions, but solutions do exist. And it's like, only if I would have known when I ran into that situation in the past, I could have made life so much better for the client and I would not have lost sleep. Point is, there's options that we can prevent MECs from occurring. Anyway, that was some extra information. Hope you enjoyed this one. It is really fascinating, no matter how long I do this, the different things you can do with life insurance policies. Where typically we think life insurance, when I die, money gets paid out, because it's insurance on my life. But then we look at the cash value component here, how to maximize it, how to really fund it for a long period of time, rich cash value up front, rich cash value long term, rich death benefit long term as a result. We didn't touch on any of the loan aspect where I can access that money while it continues to compound. It's fascinating, no matter how long I do this. Anyway, if you have questions, please feel free to leave them in the comments below. You can email us direct as well. And if you enjoyed this, please hit the like button, subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.